Lehman Brothers did not begin as a bank. It began as a family decision to survive and to learn how to earn money in a new country. In 1844, Henry Lehman, a 23-year-old immigrant from Bavaria, arrived in the United States with almost no capital and no connections. He settled in Montgomery, Alabama, a region whose economy was built almost entirely on agriculture, and above all, cotton. There, he opened a small store with a simple sign, H. Lehman. His starting capital amounted to just a few $100s. Adjusted for inflation, that is roughly $15,000, $20,000 today. The business itself was modest: fabrics, tools, clothing, everyday goods for farmers and plantation owners. This was not a dream venture. It was a business of survival. But from the very beginning, Henry did not think like an ordinary shopkeeper. He carefully observed his customers, how they paid, what they lacked, and what truly held value in their world. Many had no cash, but they had crops. And this is where the first financial insight emerged. When his brothers, Emanuel and Mayer Lehman, joined him, the store became Lehman Brothers. From that moment on, the business stopped being a one-man operation and turned into a family-managed system. All decisions were made within the family. Profits were not spent, they were reinvested. Risks were discussed collectively. In the mid-19th century, cotton functioned almost like currency in the American South. Lehman Brothers began accepting cotton as payment, cautiously at first, then systematically. They stored it, resold it on larger markets, and found buyers beyond Alabama. Gradually, the shop transformed into a financial intermediary between farmers and the market. Lehman Brothers was no longer just selling goods, it was financing production. The brothers extended credit against future harvests, fixed prices in advance, and earned on the spread between local and national markets. This was a decisive moment. Lehman Brothers moved away from physical trade and began earning on financial flows. The DNA of a future investment bank was taking shape. By the 1850s, the company's turnover reached hundreds of thousands of dollars, equivalent to millions today. For a business that began as a single small shop, the growth was extraordinary. And the brothers understood one thing clearly: staying in Alabama meant limiting their scale. The move to New York became a turning point. It was not merely a change of location, it was a change of role. Lehman Brothers entered the world of capital markets, exchanges, contracts, and trust, a world where people traded not goods, but risk itself. Yet even then, the firm remained entirely family-owned. Lehman Brothers was not an institution. It was an extension of the Lehman family. Strategy, control, and authority remained concentrated within the family circle. By the early 20th century, Lehman Brothers had become one of the most influential financial houses on Wall Street. The firm financed railroads, industrial giants, oil companies, and major American corporations. It played a key role in bringing companies such as Woolworth, Sears, and General Foods to the public markets. The personal wealth of the Lehman family was estimated at tens of millions of dollars at the time, equivalent to hundreds of millions, and by some estimates over $1 billion today. Their word carried weight. Their capital shaped industries, but embedded within this success was a structural weakness. Lehman Brothers was governed by a belief that family experience mattered more than systemic constraints. By the 1920s, the firm was heavily invested in the stock market, actively using leverage and financing speculative ventures. During that decade, the Dow Jones Industrial Average nearly doubled. America believed in endless growth, and Lehman Brothers believed in it too. Then came 1929. The stock market collapsed. Prices fell relentlessly. Ultimately, the market lost nearly 90% of its value. Assets once considered solid evaporated. Capital built over generations melted away in months. Lehman Brothers did not disappear overnight. But it lost something far more important: control. The family's capital eroded. Confidence collapsed. And in the 1930s, the last key members of the Lehman family who had directly managed the firm passed away. Without its family core, the model disintegrated. Lehman Brothers transitioned into the hands of hired managers. The name remained, but the dynasty ended. This was the firm's first collapse, not a legal bankruptcy, but a historical one. The company survived. The family did not. In the second half of the 20th century, Lehman Brothers existed as a modern corporation. It grew again, but it thought differently. Risk was no longer controlled by family judgment, but delegated to models, systems, and markets. After separating from American Express in 1994, Lehman Brothers regained independence and began an aggressive expansion. In the early 2000s, the firm made a decisive bet on the housing market. It became one of the largest players in mortgage securitization. Subprime loans were bundled into complex financial products and sold as safe assets. By 2007, Lehman Brothers held over $600 billion in assets, more than the GDP of many countries, but its equity stood at only about $25 billion. Its leverage exceeded 30 to 1. A 1% decline in asset values was enough to threaten its survival. When the mortgage market collapsed, history repeated itself. Assets turned toxic, liquidity vanished, trust evaporated. On September 15, 2008, Lehman Brothers filed for bankruptcy. Its liabilities exceeded $600 billion, the largest financial collapse in history. This time, the Lehman family was long gone. The first collapse destroyed the dynasty. The second destroyed the company. And between them runs a single line. Lehman Brothers always believed that scale and experience would protect it from systemic collapse. Twice, the market proved otherwise. Lehman Brothers is the story of how a family empire became a corporation, and how a corporation became a symbol of global catastrophe. They began with a few $100s. They once controlled the equivalent of hundreds of billions, and they lost everything, twice.